Have you ever thought about buying a business? If you have, you'll really like this interview, in part because it proves you can do it with almost any background. Ben McKay went from paragliding to private equity business development, and he took what he learned sourcing deals to go out and buy 4 businesses on his own. And what's especially cool about this interview is that Ben really reveals the ups and downs. There's no revisionist history. He talks about dealing with seller fraud, management issues, an industry downturn, getting your equity wiped out, and how to protect yourself in the process and just keep going. It's also interesting because Ben focused on smaller companies, businesses with $1 million to $3 million of EBITDA, which can be a great space to play in because a lot of private equity firms consider those targets too small to get involved. So you have less competition to deal with. Now, this conversation does get technical a few times, but I've added visuals from the website to help people through the process. All of this content pulls from asimplemodel.com, and if it's moving a little quickly, you can access all of it on the site. All right, team, let's dive in. I get so many emails from people saying, like, is it possible to get into private equity with X background, which I think makes your story just awesome because you were in Jackson Hole, I think, paragliding with one of the partners at Evolve. And that was really like the catalyst for how you got into the industry, right?
Yeah. And even before that, it was like, how do I live in one of these mountain towns and like live a lifestyle other than, being a bartender or doing something else? So in my 20s, I was a ski bum for a while and then was an outdoor guide. And I was just long-term, I was like, man, I'd love to be able to live in one of these places. How do I do it? So I went back to business school because I had to shift from my outdoor profession to more of a, I had to like pretend I was a business guy. And
you went to Babson, right?
Went to Babson, yep, for my MBA.
Which is a heavy entrepreneurial focus, which I think is very cool, especially for everything you've done since. I think that mindset helps a lot.
Yeah, and I found that while I was there, a lot of the case studies, talking to other people that were in other business schools, we were reading the same case studies, but we were taking more of a small business approach to, evaluating what was going on or learning from that. So definitely helped. And then I was out in Jackson Hole working for a company called Cloud Veil, which is an outdoor clothing business for my summer internship. And then I was flying paragliders because spreadsheet modeling was boring me. And and so in the mornings and the evening, I was flying paragliders and I met this guy and he was like, hey, I want you to come work for me down in Dallas. And I'd never been to Dallas in my life. And
what was it about that combo? Like, why do you think he offered to have you come down?
We'd meet up like every morning and every afternoon and fly. And I think we just became pretty good friends. And you're asking sort of me to evaluate myself in a way, which sort of can be dangerous. But I think he saw I was just good with people and pretty confident and not really afraid to take risks, tend to make friends pretty easily. And I think he was looking for somebody to be more on the front end running deals. And he already hired a lawyer and a kind of a finance guy, sort of an Ernst & Young type finance guy. And so I think he was kind of rounding out the team or thinking that I might fit. So he said, why don't you come on down? And I said, all right, might as well just go down there with an open mind. And after, it was like a 4-day sort of like in-home interview.
And that's awesome. So I hadn't realized this, but was that your first introduction to Dallas?
Yeah. And, coming from Minnesota, I was like, okay, hadn't spent a lot of time in like the South. And I don't think of Texas as the South. It's just its own thing. But, and now I know what it's
Texans
all about.
Appreciate that.
Yeah. Yeah. But yeah, loved Dallas, loved Texas, and obviously made a lot of great friends when I was there. So, still miss it.
And so that role, that was biz dev trying to find opportunities effectively?
Yeah, so that was sort of how I started out. And luckily, I walked into a pretty big database of investment bankers and business brokers to interface with. And being in my 30s and single, I could travel anytime. And I was all over the country, different cities, doing like 5 to 7 meetings a day, and just really hit the ground hard and built a pretty big network of folks who are representing companies for sale. And
how did your approach evolve? I mean, I think you all were looking for bank deals, but also largely proprietary deals. I think we met a lot on just that conference circuit, but then I remember your strategy sort of evolving over time, and you had a group of people that you would regularly reach out to. Walk us through that. How did you really like fine tune your approach to finding interesting transactions?
Yeah. So this was back in like 2007, 2008. And so the market was pretty different then. Pricing was different. Pricing was sort of 3 to 5 times EBITDA.
Dude, if we'd only known.
I had a database, probably 5,000 to 7,000 investment bankers. a lot of really old school guys. And there's a saying that a person can keep up like 200 to 300 relationships, but once you get above that number, it's like a networking stat.
Oh, that's interesting. I was reading about Gore-Tex, and they basically build each plant to 150 people because that's the number of social connections you can maintain. And they want to have like a strong cultural feel within each location.
Yes.
Once they get to that number, they just open a new location.
Exactly.
Yeah, fascinating.
So my approach was, okay, I'll go to every one of these cities. I'm going to meet up with as many of these guys, research them, find the best guys in every city, meet up with them, get to know them, and really develop relationships and getting to know all these people personally, and my number was more to 200 to 300 or so. And then following up every month, probably on the phone, and then mass emailing the remainder of our group. As everybody knows, kind of in the M&A world, you want to stay out of auctions. You want to get good pricing. Typical structure has a retained equity piece for a lot of sellers. So the unique thing is that you're buying a company, but also you're getting a partner in the founder. And so, if you kind of screw them over in the deal in the beginning, you just start off on the wrong foot. So we never were really trying, and still to this day, you're never really trying to beat somebody down to get like ultimately the best pricing. You're just trying to get a fair deal.
And what kind of deals were you looking for then? Like, what was your sweet spot?
Yeah, so the Evolve focus is still got a very strong history in healthcare services. So we've got Medicare reimbursed home healthcare, Medicaid, group homes for developmentally disabled people, autism services, and really anything related to healthcare services is right down our alley. Beyond that, there's sort of opportunistic stuff. So specialty cleaning and inspection companies, manufacturing and assembly of highly engineered components like valves and meters and sensors. I mean, I've been doing this a little over 15 years now. You sort of start analyzing a lot of different companies, and you sort of fall into these businesses that are like, that these particular ones are going to work.
You're looking for highly stable, highly secure, more old economy.
Yeah.
And slightly industrial.
No tech, no real estate, no construction. Yeah.
And then I'm curious, I remember you were in Dallas for a while, and I remember you started exploring the idea of moving again and also of looking for transactions by yourself. I think what's interesting is most of the time you have to make a clean-cut decision to go look for that. You had an opportunity to continue sourcing, but also look for opportunities yourself.
Yeah.
How did that evolve? How did that come together?
So that was 2012. I think, as a ambitious 35 or 6-year-old, I thought, man, I'm seeing all these deals. We're not doing that. Like, the stats are, Peter, it's like you got to look at like 1,000 deals to do one. And that's sort of the vernacular thing, stat. And I think it's accurate. So we were looking at all these deals, and I was like, God, there's like a $1 million EBITDA, $1.5 million EBITDA size business out there that could be really cool. And I wish I should really go try to buy one. And so I started thinking maybe I should try to do this on my own. And so really, I actually formally left Evolve. Did a little bit of back and forth between Jackson Hole and Dallas between 2012 and 2014, and then 2014 started my own thing. I just kind of went for it. The biggest risks being, dead deal costs. Kind of put everything I had into it. Sublet an office from a real estate company up here. Bought a place, an old log cabin, renovated it myself, kept my fixed expenses really low. And the whole plan was if it all blew up and I lost all of my personal savings, I'd be happy living in a mountain town, skiing and being a bartender or whatever.
I got to say, it's completely unrelated, but I love the story. You took a course on how to build a log cabin and then managed to buy one in Jackson Hole before property prices like exploded, and you properly built it. Like, I remember going to visit it. It was absolutely wild. Yeah. But that's as scrappy as it gets when you want to start something yourself. Yeah. But it's interesting because when you started, I mean, certainly when I first got into private equity, and I think even at around the time when you left, like independent sponsor carried a very different meaning. It was nearly like a bad word. Like you didn't want to be associated with it. Whereas today there's private equity firms that are funded and formed to pursue independent sponsors. So it's a bigger risk then. I mean, the idea of securing capital and the dead deal costs you're speaking to, which I think still hyper relevant. Maybe you want to speak to that a little bit. Like when you're pursuing something, the amount you can accrue in expenses before you close and what happens if you don't.
Yeah. Yeah, that's like when a younger person, I still think of myself as pretty young, but then I start talking to people in the industry and I'm realizing that I'm actually getting older. And so when they're like, how do you
I
get
hate that.
into private equity? Or how did you do what you're doing now? I have a lot of philosophy around it. That's kind of a long conversation, but I usually tell them there's a bunch of ways, traditional ways, like you go to an investment banking training program for 2 years, kind of cut your teeth, and then you go try to get hired by a private equity firm. And there you're competing with all the other smart people in the room, and it's just kind of a beatdown. The other one would be working for maybe a mezzanine debt fund, which is cool because specialty lenders, they see all the deals, they see deals that are already vetted. And then the other one would be working for a small investment bank or business broker representing companies for sale. And those are sort of the three that I bring up. And then there's the other one, which is just start calling up a bunch of investment bankers and business brokers. I didn't even realize there's a giant network of these people out there. They're like real estate brokers, but they sell businesses. And I didn't even understand really what an investment banker was at the time. And so there's just this whole universe of businesses for sale. So started getting into that. And then I learned, okay, you let's say you find a company you like and you submit an indication of interest and you get acceptance on your terms, and then you submit your letter of intent. And then you have, typically 90 to 120 days to close the deal. First, you got to figure out, is the business financially what you thought it was? So you got to get the quality of earnings, you got to get a third party financial firm to come in and substantiate the size of the EBITDA that you're pricing the deal off of. Then when you do that, then you can go find a lender, and then you start diving in on the legal side of things. And
that's where the bills really start to add up. Between your Q of E and legal, you start racking up some serious expense.
Yes. And so I start talking to a lot of these folks that want to get into it, or maybe just buy one company, and I say, okay, everyone's like, here's what you got to do. But a lot of people forget the risk of the dead deal costs that you could be into it 200,000 or 300,000 or more. And if the seller decides not to sell, or you find something really bad in diligence and you just figure out you can't do the deal, or your lender gets scared or something like that, there's 1,000 things that could happen that could kill a deal. You're stuck with those fees, theoretically. That's where setting up your process to limit your exposure to dead deal costs is really important.
I think it's interesting. Most people try and look at their living expenses for, 12 months, 18 months, 2 years without thinking about the fact that they'll have several $100,000 on the line. And if you don't close, it's your obligation. How do you limit it? How do you limit your exposure outside of great relationships and trying to negotiate something that some people will or will not give you?
So the first thing I try to do, and it's actually started to get adopted more. Not everybody allows it or will do it, but I try to get the seller to finance the first part of the quality of earnings report, and then you tell the financial firm that you want them to substantiate EBITDA. You don't need anything fancy. You just want to get in there and have them tell you, okay, EBITDA is what you thought it was. Or not.
So strip down the scope initially.
Strip it way down and have the seller front the first. It's usually 10 or 15,000 of that cost. And then if it doesn't work out, then you can't do the deal, and then the seller holds that. But then they also own that report and that piece of information.
You're telling the seller, you're representing, you have this EBITDA. I'm asking you to confirm it. Is that sort of how you get them on the line for that?
Yeah, I mean, sometimes they'll just say no. Or their banker will say that's not normal. I would say more and more it actually is becoming normal. I talked to a lot of people and they're totally fine with it. In fact, a lot of investment bankers and brokers are having their client go through a Q of E just in their process to get them ready for sale. If you really had to push on it, you could say, well, hey, do you not think your earnings are what you said they are? There's sort of that argument. Like, stand behind what you're telling me. So there's a lot of ways to get that done. And then usually what I'd say is that gets reimbursed at closing. So we close the deal, no problem. Like, we'll reimburse that cost to you at closing. The next one is the legal. Like, once you know that EBITDA is what you think it is, and that substantiates your value and your structure and everything, then it's legal. And, that's like between 100 and 200,000 probably a normal deal to get it done. Some firms will say, hey, if it's a dead deal, you pre-negotiate it with the law firm and you ask them maybe to cut it in half if the deal dies. And some will do it, some won't.
And I think there's growing practices that really do accept that. Like there are groups that really try and work with independent sponsors and bring in that deal flow.
Yeah, there definitely are. And like the independent sponsor model has really expanded since I started. I don't think it really existed very much when I first got into it. And so there are definitely some lenders and attorneys out there that focus on it. And I think they probably got a very established process for all that stuff now.
I think the unfortunate consequence, if you get to that point and you haven't managed it well, and you find something you think you can close on, but you're not exactly like stoked about the transaction, but you have those dead deal costs, it's a very negative incentive to pursue something that may not be the best use of your time for the next 5 to 7 years, unfortunately.
Yeah. And I got 3 deals done by myself in 18 months.
It was 3 deals in 18 months?
Yeah, just back to back.
I did not realize that. So how much work had you done? Had you identified the targets before and then?
No, but I had so much deal flow. It was just crazy, because I was just like a one-man band and all I did was hit the phones and meet people all over the country. So I was probably looking at 50 to 60 deals, I think a month.
Wow.
Maybe more. Maybe that was a week. Something like that. It was definitely.
So how long had you been sourcing for Evolve up to that point where you broke off?
6 years.
6 years. Okay. Wow. Yeah. Okay. So you had a phenomenal database.
Yeah. And it was my 100%, I was everywhere all the time. So,
yeah.
And I would tell people the other sort of normal thing is it takes you should plan on about 2 years to find your first deal if you're starting from scratch.
That's phenomenal. So what were the 3 businesses?
One was a compounding pharmacy that totally blew up. And it was
What happened there?
So the seller fraud situation, they said, we don't have any sales to family members. We don't have any sales outside of the state. And it was even in their, in the purchase documents that they rep to. And then about 3 months after we bought it, performance really wasn't keeping up to what we were expecting. And so we started digging into it and we were like, what's going on? And the sellers kind of tried to hide it for a little while, but then we figured it out. And effectively EBITDA went from like 1.7 to like 500,000 maybe. So like 2/3 of the EBITDA was sort of sales to people that were buying because they were like relationship sales,
Yeah, they were inflating their sales right up to the close.
Yeah,
basically.
And they rep to that. And then I learned how hard it is when someone wants to kind of screw you over and then and they're hiding it. Even with professional diligence and our own digging in on stuff, like we didn't find it.
Yeah.
And
I remember that's something I always remember. I had, when I was younger in the space, someone told me if they want to fool you, they will, and a Q of E won't catch it. Like you really have to know the people, your partners, and do reference checks with everyone that they've ever worked with, because anything that comes up, any red flag, you got to pull on that thread and figure it out. But if someone absolutely wants to fool you, they're going to. So
that was really hard. Lost our equity on that deal and obviously our carry. And I stayed involved to help my lenders recover whatever they could get. So learned a lot there.
That's hard. I got to say, I think you work the hardest when you get paid the least in this space. It's like you close on something and it's lightning in a bottle. You're going to do fantastic and your carry position is going to look amazing. It's when you're in liquidation or really working through problems or forbearance that you work the hardest and get nothing. That's the risk.
And you learn a ton, and you develop I developed a whole another side of my personality, for better or worse.
How long did it take to work through that?
2 years.
Wow.
Yeah.
Which is important to keep in mind. I mean, for people watching this, if you close on the wrong transaction, it's a substantial investment to get out of it. And especially if you're not looking for something else or you're not investing in something else, that's sort of your entire career until you get out.
Yep. I was really lucky to have my second deal done pretty quickly, like all that's going on, and I've got my next deal like closing.
So you're busy.
And so that one was a specialty structural steel component manufacturer for cell phone towers. The thesis there was this was when there was 4G and 5G wasn't out yet, and most of the cell towers in the United States were structurally overloaded. and it was a lot less expensive to retrofit an existing tower than it was to build and permit a new tower. So this company would make giant pieces of custom steel to put up on existing towers to allow new equipment to be put on the towers by the tenants of the tower, which are the carriers like AT&T and Verizon. And that one did pretty well. But then 3 months after closing, the industry took a giant downturn because of the 5G spectrum auction. So we were all of a sudden going from making money to losing about $125,000 a month. And so I had to call my lenders on that one. Had to go raise $1 million to fund operating losses for up to 12 months, I think, or it might have been 16 months in my model. Because my thesis was, this is an industry thing. It's an industry-wide auction, which was true because they were repurposing spectrum, which is bandwidth from commercial broadcasters to cell phone carriers. And so this was one of the major times when the big carriers could get bandwidth for the 5G rollout, which, if you remember, was like everybody was thinking it was going to be this major thing, and it's kind of turned out to be nothing.
Yeah.
But if you're AT&T and this is the opportunity to get bandwidth, you're not going to spend money on anything else, and you're going to try to win the auction and buy bandwidth. So basically, all the retrofits of towers were put on hold, and my thought was, okay, let's just stay alive through this downturn. Everybody was fine with it. Lenders took maybe 6 months they were taking like half pay for like 6 months, and then went back to full payment. And then after that, we were doubling revenue for the next 2 years. Just boom, boom, just
phenomenal,
just growing out of it. And then actually an old buddy of mine that I saw this past week, what happened to be the biz dev guy for a Trinity Hunt company that was in the tower space. And he called me up. He was like, "Hey, Ben, you still got that tower company?" I was like, "Yeah." He's like, "Well, we kind of want to buy it." And I'm like, "Okay."
Okay.
And so it was, it was pretty awesome.
So when you went back out for equity, you have a downturn. That's exceptionally hard. That, you have an industry shift. That soon after close, you went back to your original equity investors and said you have to re-up.
Yeah.
How difficult was that conversation, or did they have confidence? Did they understand it also? I mean, it's interesting. So much of this is a confidence game, like up to close. And then if something goes wrong, it's kind of, again, like this will work. But how are you pitching that to them?
I made a lot of phone calls and got a lot of industry sort of intelligence. And I was like, what is going on with this thing, right? And so the argument effectively was, if you believe that the telecom industry is dying and there's going to be no more cell service, then don't come in. If you think that this is an essential service to, everybody in the world, and you understand what's going on here, then you should come in and protect your investment and the company. But I did have to give up a bunch of equity. I mean, like, I made it very lucrative for this new money that was coming in, because it was risky.
Yeah.
Most of my investors are very seasoned people. They're either like former mezzanine fund guys or like really old school private equity guys. And so they know this stuff happens. And they understand what's going on.
Yeah. It helps to have very well-informed partners on everything. How long was your hold before Trinity approached you?
I forget a little bit, but I think it was about 4 years.
Oh, that's wild. That's from close to turnaround to exit. That's pretty awesome.
Well, during the downturn, and so this is a lesson, if your industry is in a downturn, the best thing I think you can do, and we did it in this instance, was to get out there and just start selling. So like everybody else freaks out and pulls their horns in. Instead, we were like, okay, we're going to like market ourselves so hard and try to bring in new customers. And so even though they weren't buying right away, when it did turn back on, we were the people. And that's why
you captured market share through relationships for the turnaround, basically.
Yeah.
I don't think I fully appreciated that part of the story. I can't remember when you last told me about it. I think maybe we're at Go Lightly. That's a tight timeline for that kind of volatility and a successful exit. That's awesome.
Well, yeah. And I think that it worked also because that industry tends to be a little bit cyclical. So it's going to have its ups and downs. And then the third one? Yeah, the last one was a dental lab, which actually came to me through a dental consultant that I'd been networking with. And he and the seller were supposedly really good friends, and we were going to buy it. He was going to come in and run the thing. And I like that space a lot, because the dental lab space in particular, because it is effectively specialized manufacturing of relatively low cost components that have to be perfect. Because like if you have a fake molar in your tooth and the shape is wrong by a fraction of a millimeter, you're going to know it. Like the patient's going to know it.
Yeah.
And then typically oral surgeons are buying our services with credit cards. So it's cash pay, pretty quick cash cycle. And then on top of that, there was a major technological shift going on in the industry from film to digital. So, instead of like x-rays and things, all of a sudden it was total mouth scans that would then get sent to a 5-axis routing machine. And then there was like CAD CAM designers, 3D computer models of teeth. And so the entire workforce was shifting over, and the technology. And so plus the owners of dental labs were getting older. And so they didn't want to invest, $250,000 to $750,000 in new equipment when you're 75, and you're not going to see the return on that in maybe until they're 80. So there was a compelling pitch to go in and look at a lot of that stuff. And this lab that we ended up buying was actually a great lab. Unfortunately, there was some the guy that I went in on the deal with, they weren't actually the best friends. And, there was some rub between the founder and this consultant and the lenders. And, it was a little messy, but I think luckily everybody sort of played well in the sandbox to the best of their ability. And we ended up selling that at a decent multiple. So those were kind of my three, just like firing them off. And honestly, I don't know. I think I had some guidance from a mentor of mine that said, you just have to keep going. I mean, think back on that time, I think that was crazy. Just
all overlapped, right? I mean, you're doing this all at the same time.
By myself, from finding the deal to closing the deal to running the company, everything. I did everything myself. Now, like I remember after that, I was like, okay, I am a machine now. And that sounds really cocky. And,
no, it's awesome. It's trial by fire, and
yeah. And I'm very cognizant of not being cocky about stuff, but like, I really do know what I'm talking about now. And like, I realized that. And then I ended up,
wait, if you had to, before you jump to the next, if you had to summarize like top 3 lessons learned when you went through that, because you had a cyclical downturn, you had trouble with the management team, you had fraud, like you had sort of all the things people really freak out about, and you had 2 successful exits, and you got your lenders covered in the other. I would consider it success given what you endured.
Yeah.
If you had to summarize, like, these are the 3 things I learned from that I'm going to carry forward. Have you ever thought through that?
Yeah. So one is manage your dead deal cost process in the beginning, obviously. I was very lucky and knock on wood, I've been very lucky I've always closed the deals that I've tried to close, which is like, that's also scary for me to say, because I know it's going to bite me in the ass. But
there's a skill to that, because you have to know that what you're pursuing is viable. I mean, you're looking for, at least the way I think of it is like anything that feels slightly off, you have to explore in its entirety to try and make sure you're covering that well. And I imagine that's the exposure you're getting.
And you're managing a lot of angles all the time, and it's always shifting. The other one is at closing, I try to take a closing fee. So not only would I get my deal costs covered, but I would take a closing fee that kind of helped me live for just getting the deal done. So there's like, and I think that's justified, in the course of, 90 to 120 days of somebody trying to get a deal done. Not only are there the deal costs for the, the outsourced attorneys and the finance people, but like you actually got the deal done too. So you got investors into the deal, you created value, and you're rolling forward. So you take a small deal fee for that. And that allowed me to continue to live. And this is the message I guess I would send is, you have to make sure you can live to fight another day. Management fees were cut off fairly quickly after I closed a deal. My living expenses weren't covered. I had no safety net. It all would have blown up.
Well, I think there's a rationale for a closing fee. If you have a private equity fund, you are charging up until you call capital, right? I mean, there's a fee associated with the pool of capital that's supporting the team there. In this case, if you're not doing a funded search, and I don't think you were a true independent sponsor, you don't have that same coverage for that time where you're exploring and sourcing. So I think there's a rationale for it, and I think it's easy to argue for, or it should be easy to argue for.
So that really helped. And I do think just keeping going actually was good advice, even though it sounds absolutely crazy. It's like, don't get comfortable stopping at one, especially for your first deal. I mean, there's just so much learning that goes on.
So the one I'm most jealous of that you told me about recently is Brown Miller Racing, BMRS. Yep. Would love to hear that story, how you found it. And I've heard some of sort of the surprises through the closing process and post-transaction, but would just really enjoy hearing it.
Sure. So after those 3 deals were done and I'd sold them all, I'd stayed in touch with the Evolve guys, and then and we're amicable and everything. And so in 2018, they asked me to come back, and I was at a time in my life when I could use some like steady income. So we worked out a deal, and it was similar to kind of my previous deal with them. But one point was, hey, if I find something and you don't want to do it, then I want to be able to go do it on my own. And so that's what I'm doing right now. Is I'm sourcing deals for Evolve. Technically, I represent them on the deal sources side when I'm talking to investment bankers or business brokers. I still have my business, which is Long Trail Holdings. So I was back on the road, just like the old days, looking for new deals.
Yeah, that's awesome. Okay, so I didn't realize they basically have right of first refusal, but you're showing them everything you see.
Yep, and that was great because I really did need the steady income at the time because I'd sold those companies and moved on, but I didn't want to get out of the industry because I'd been doing it enough, and now I realize I learned enough that like I'm not going to go reinvent myself into another industry. Like I am basically a private equity independent sponsor guy, and that's what I'm going to do. So in the course of looking for deals for them, this deal popped up from a business consultant that I knew. I was like, oh, this is sort of my holy grail. Like they are a manufacturer of critical components that go on, specialized vehicles. And really the reason it fit for me is it was really a manufacturer of highly engineered components, relatively low per unit selling cost, serving an essential function. That's pretty broad, but this one effectively.
But I think what you're saying, I mean, I love it because anywhere in a supply chain that you identify the low cost critical component, whatever it is, it's a great niche to be in. It's a really attractive space.
Yep. So that's what I'm always on the lookout for. And then, so I tried to get Evolve to do that a few times. And I think a bunch of private equity, like traditional private equity people had looked at it. And the issue was, so we make high pressure, high temperature hoses and fittings for race car engines, professional race car engines. So this is NASCAR, IndyCar, Baja race trucks. Don't do much in Formula One, although we dabbled in it.
What a fun thing to find yourself in, man. I mean, that's in terms of being an independent sponsor and finding something you're going to get finding something you're going to dedicate yourself to. That's a fun space to be in.
It's fun. And like, I'm a mechanical person anyway. So I like all that stuff.
I saw that. I saw you just rebuilt a snowmobile for your kids just for fun.
Yeah. I got that one for free. It needed a few things fixed on it. Like it was an old Briggs and Stratton go-kart engine that needed a little help. Luckily, as a kid, I knew a lot about those. So really that was just before COVID. And I spent a lot of time thinking about how am I going to go after this? Do I want to put all my own money into the deal, or do I want to try to get some investors or partners? And went through a lot of different versions, different lenders. And then COVID happened and we kind of put the deal on hold. And the sellers are two just great guys, engineers, built the company like 25 years ago. Really just enjoyed the sellers, got along really well with them. I think they were very upfront and honest, and so was I. And also we had an extremely long dating process because of COVID. And so I think we'd been talking for maybe 2 or 3 years before we closed the deal. It gave everybody an opportunity to really get to know each other and understand how's the business. And so it's been great.
So tell me again, the reasons private equity firms shied away from it, what do you think that was?
Yeah, they were pretty much fully penetrated into their main markets, NASCAR, IndyCars. So most people that would analyze that would say, okay, you're 100% in your main markets. Like the only thing you're going to do is lose customers. And the only way for this business to go is down, which I don't think is an unreasonable argument.
I want to get back to that in a second, but just before going through your closing process, I remember this was one of like the most positive, pleasant surprises, right? You had your Q of E. Tell me how you got the Q of E surprise. I'm not remembering the story properly.
I don't know. You've got a better memory than I do.
You said, I think you all had an estimate of earnings or cash flow. And then post-close, there was some adjustment. I don't know if it was to inventory or some cost accounting estimate that they had, but I thought there was a surprise to the upside in their earnings.
Yeah. Oh, you know what? You know what happened? It wasn't the QOV. The QOV was accurate in terms of what we thought the size of the business. I think it was like 2.5 in EBITDA or something at the time.
Okay.
But what happened was, so we in 2022, like the quarter before we closed, or the first half of the year before we closed, was like a blowout year. So because of COVID, we control all of our supply chain, which almost nobody does in our industry. And so we have the ability, we didn't run out of supply. So when everything shut down, we still had supply. And then when there were the China tariffs that happened, the first round, we weren't importing anything from China either. And then inflation happened and supply, we could raise our prices moderately without trying to price gouge people. All of a sudden, customers just kept coming to us. And so they had, before we closed the deal, they had this blowout first quarter or first half because they just picked up a ton of new customers, which was great. And in the deal, though, I felt good about it because in the deal, they retained some ownership. So they got upside there. I structured the seller note where if the business did well in the first year after closing, they had the ability to double the size of their seller note from the original closing value of the seller note. So that was great. Like, and so what they did is they maxed out that. So they doubled the size of their seller note. And so, but hey, that's fair,
Yeah. Y'all were aligned on performance. So it worked out well.
Yeah. And like what I was saying earlier, like if you try to screw over your seller as a buyer and they're supposed to be your partner, and then they had this amazing blowout year and then they're like, well, I didn't get anything for that. There's like this sour thing. So
that's cool. And then as it relates to continuing to grow, I remember you telling me, I can't remember when it was, but I think you made the introduction to Singer Porsche. Is that right?
Singer was already a customer of ours.
Oh, okay. They were.
They just started, and we started growing with them. And so that's been amazing. They're really
so do you find yourself now, I mean, you have this fantastic capacity to network and find transactions. Are you using that within the company as well? Like, are you trying to develop new avenues?
I think there's so much organic growth in front of us. Like the other thing is aerospace and defense needs what we provide, like very specialized hoses. And so we're starting to do work for various rocket companies, drones, things like Singer and other sort of supercars and these really amazing, cars, race cars and things. They want the premium product. We test everything we make. Like there's just nobody doing exactly what we do.
That's awesome. So at this point, are you just full hold? Are you looking for acquisitions? What do you think? I mean, add-on acquisitions or separate acquisitions? What is the long trail strategy?
So now, no, we're not really looking for add-ons for BMRS because of the organic growth potential. Although if something comes along, great. No, but I think I need to start hitting the road more. And I'm starting to do that right now. So my plan is to start traveling like 1 week a month, looking for new deals, which honestly, it makes me feel good. Like if I don't have opportunities that I'm looking at, I get kind of like anxious, which is sort of, I mean, it's probably good and bad, but like I told the Evolve guys when I went back, I was like, guys, I'm just built for this now. Like I'm not going to read about myself. This is who I am. The cool thing about this industry is as you get older, you just get better.
There should be so much opportunity coming. What are you looking for now? Do you have select criteria or is it very much kind of case by case?
Pretty broad. Yeah, still pretty broad.
That's awesome, man. I can't wait to see where BMRS goes. It's really exciting to have that kind of organic growth. And the fact that you're, I guess, expanding into aerospace, drones and satellites, I can't imagine that was anticipated.
Well, it was a little bit. I saw, so in my diligence with the company, like I realized that a lot of professional racing engineers, like race team engineers, they get plucked out to aerospace companies.
Oh,
and
interesting.
Then with the advent of all these private aerospace businesses, it's just kind of exploding, like exploring space and things like that. A lot of these race guys are going over there and they're like, oh, we need hoses for this rocket. Like, who are we going to call? They call us because they know that we provide the best product. So we're naturally getting pulled into this stuff. So what I did is I called up one of my friends who's probably one of the number one aerospace and defense M&A investment bankers in Connecticut. And I was like, hey, who's the best recruiter in the industry? Because I was trying to recruit leadership for BMRS. And he hooked me on up to this guy and ended up finding some really, really great talent.
That's cool. I was just reading about Aon Corp and how they grew, and the founder there, who I guess grew to a double-digit billion-dollar company, he had a goal for himself of hiring 30 people per year through his personal network, and that's all he would do. Every time he had a conversation with anyone impressive, he'd just ask them, based on what you know of my company, who's the most talented person I should hire?
Yep.
And he did that, and he encouraged his top guys to do the same thing. So everyone had a 30-person quota.
I think I might have read that article too. That was good. Yeah, it's a good one.
Yeah, it's neat. I mean, I think private equity is so dependent on its people. If you're not as much focused on human resources as you are capital, it's a hard game to win.
Very people oriented. People say you're in finance. I said, no, I'm in a people industry.
Well, dude, this is awesome, man. Thank you. I appreciate the time.
Yeah.
And
always
really, really fun to hear the full story.
Yeah. We'll keep you posted on how it goes.
Yeah, absolutely, man. We may have to do a follow-up. Appreciate it.
All right. Thanks, Peter.